Hello, everyone. Thank you very much for joining us once again today. Welcome back. We are discussing today transfer pricing and its importance. And this is part of decoding UAE corporate tax law. Whatever we have discussed till now, in our previous lectures till now, we have conducted 24 webinars. In these 24 webinars, we have tried to cover the scope of the UAE corporate tax law. We discuss exempt persons, out of scope persons, UAE source income, permanent establishment, application of corporate tax on the partnership, free zones, family foundations, how to compute the taxable income, deductible expenses, interest capping rules, small business relief. By the way, very comprehensive guide has been introduced on the small business relief that we'll be discussing in our next webinar. We have already discussed tax grouping, tax loss provision, relief, free zone consultation paper, participative interest and its taxations, application of corporate tax on the trading companies and applications of corporate tax on the manufacturing and processing companies. Today we are discussing transfer pricing and its importance. What is very hot topic, everybody is asking about transfer pricing, how to set the prices, what should be the price between the related parties, what are the related parties, what are the connected parties, how to set the price, what is the importance of transfer pricing, what are the different methods of transfer pricing, what is the documentation requirement, and in case transfer pricing rules or regulations are not being followed, then what will be the implications. In this lecture, we will try to cover the basics of transfer pricing. We'll try to know what is transfer pricing, what is the importance of transfer pricing, how the businesses can shift their profit from the high tax jurisdiction to the low tax jurisdiction, what are different methods for benchmarking, and in case these methods are not being followed, what will be the implications on this. In our next lectures, might be in our coming lecture or in any lecture in the future, we'll be discussing the methods in detail and documentation in detail as well. So what is a transfer price? Think like this. There's a company, this company A, there's a company, this company B, this company has the common ownership and Mr. X is the owner. Mr. X is the owner, Mr. X is the owner of company A and Mr. X is the owner of company B. Now, this A is selling any goods or services to B. Since A and B are owned by the same persons, so Mr. X is in a position to control this price. Might be this A is selling the goods in the market 100 per kg, but he is selling the goods to B at 50 per kg or 150 per kg because the price in between A and B, this is in control of Mr. A, Mr. X. So what is transfer price? Transfer price refers to the prices of goods and services, what is being charged in between related parties. I have given you an example. X is the owner of two companies. X is in a position to control the transaction, to manage the transaction, and there is a possibility that they can shift the profit from the one tax jurisdiction to the different tax jurisdiction. So this is a transfer price. So what is the price? What is being charged between the related parties? What is being charged between the connected parties? For the time being, we can assume this is a transfer price for the discussion purposes. So I use the word here related parties and connected persons. So what is the related parties and what are the connected person? Important thing is, what is the related parties? The related parties, it has been defined in the UAE corporate tax law. They said related parties are partners in the same unincorporated partnership. Natural person having a fourth degree of kinship. We'll discuss what is this fourth degree of kinship. Natural persons and juridical persons, where the natural person is the owner of 50% or more shareholders or 50% or more controlled by the individual natural person of the juridical person. This is the juridical person, this is the natural person, this natural person is holding more than 50%. So more than 50% control, more than 50% shares. So these two are related parties. Then the law says any related party of this individual person, might be cousin, might be father, might be sister, it will be considered a related party for this company as well. Then they said juridical persons, one juridical person is holding more than 50% control. This is a company A, company B. If company is holding more than 50% shares or more than 50% ownership of company B, so A and B are related parties. Any related party of this A is making any transaction with the B, all these will be considered related parties as well. A person's and his permanent establishment, this is the related party, the trustee, founder, settler, beneficiary of the trust or foundations, or its related parties, it will be considered related parties. So we use the word fourth degree of kinship. In this fourth degree of kinship, this fourth degree of kinship can be established through the kinship affiliation. It can be by birth, it can be by marriage, it can be by adoption or guardianship. This fourth degree of kinship can be established. The fourth degree of kinship, first degree of kinship is between husband and wife, parents and children. This is the first degree of kinship. Second degree of kinship is siblings, two brothers. If the transaction is being made between two brothers, two sister or brother, it will be considered second degree of kinship. Third degree of affiliation is between uncle and aunt, niece and nephew, and fourth degree of kinship in between cousins. So if the cousins are making any transaction, it will be considered related party. Husband and wife making any transaction, it will be considered related party transactions. Uncle and aunt are making any transaction, it will be considered related party transactions. So this is the fourth degree of kinship. So we have decided what are the related parties. If any transaction is being made between these parties, it will be considered a related party transaction. Then we discuss the second was transaction between the connected persons will also be subject to transfer pricing rules and regulations. So what are connected persons? Connected persons are owner of the taxable persons. Company B owned by A is the owner of B, or A is a connected persons. Officer, CFO, CEO, CIT, any other officer of this company B will also be considered connected person. Related party of A, owner, related party of these officers. We know what are the related party. We just discussed 6 rules. So related party of A, related party of these officers will also be considered connected person. So if any transaction is being made between the related party of the owner, between the related party, in between the related party of the owner and the company, or in between the related party of the director, officers of the taxable person and the company, it will be considered connected person transactions as well. So we know till now, whatever we have learned what are the related parties, what are the connected persons, and what is the transfer pricing. Now we are going to discuss what is the risk. As I discussed in the very beginning, A can manage the transaction, because if A is the owner in company 1 and company 2, A can manage this price in between 1 and 2. So what is the risk? When the A is managing the price, there is a possibility that the A can shift the profit from the high tax jurisdiction to the low tax jurisdiction. First risk. Second risk is A can reduce the taxable profit within the same tax jurisdiction. Ultimately, it will be a loss to the federal tax authority, it will be loss to the tax authorities. So how can we look into this? Just look into this example. It will give more clarity, more understanding to you. For example, A Limited is a company which is registered in UK, where the corporate tax is 19%. B Limited is the company which is registered in the UAE, where the corporate tax is 9%. Now, if we are further assuming for discussion purposes, B Limited has given a loan. UAE company has given a loan to the UK company of 20 million dirham. Market interest rate is 5%. Corporate, and this, again, coming back to the same example, A is the owner. This is a company in UAE. This is a company in UK. This company has given a loan to the UK company. Market interest rate is 5%, but he is asking to UAE company, no, you need to charge 10%, because both of the parties are in their control. Once the both of the parties, A and B, are in the control of Mr. A, so he has manipulated the interest rate. The interest rate, market interest rate is 5%, but A is asking to UAE company, you need to charge 10%. Once they are charging 10% interest principally, and as per the market price, interest would have been 20 million into 5%, 1 million interest. Once they have manipulated the price, 20 million into 10%, 2 million interest. So look into this illustration. When this transaction was on the arm length means the transaction was not being managed by anyone. This is a fair market price. Assuming profit before tax of the UK company was 5 million, here profit before tax 10 million. Interest, this interest is at the market price, 20 million into 5%, 1 million. 1 million is interest. This 1 million is the expense, interest expense of UK company, and 1 million is the interest income of the UAE company. So their profit before tax are 4 million, 11 million, tax rate is 19%, 9%, tax amount on 760, 990. The total tax they are paying to the authority is 1750, and their net of tax profit is 13250. Now A is managing the transaction. E is controlling the transaction. A is managing the transaction. We know this UK is a high tax jurisdiction. U is a low tax jurisdiction. What the A will be trying to achieve? A will be trying to achieve the move the profits from the high tax jurisdiction to the low tax jurisdiction, means to shift the profit from the UK to the UAE. So once they have controlled the transaction, interest expenses of UK company has gone to 2 million. Initially, it was 1 million. Arm length price was 1 million. Arm length interest was 1 million. Now, controlled transaction interest rate is 2 million. The 2 million is interest rate. The profits of the UK company has been reduced. This has been reduced from 4 million to 3 million. UK company is paying tax to the government 570. Here it was paying 760. UAE company is paying bit more tax. At the end, the total tax of the A Limited, consolidated group, parent company, whatever you wanted to name it, total tax they are paying 1650. Here they were paying 1750. At the end, by controlling this transaction, they have saved 1 million. Around 1 million. So they have saved this, not 1 million, 100,000. Sorry, 100,000. 100,000. They have saved 1 million in the interest, and the saving is around 10%, which is 19 less 9%, 100,000. So they controlling this transaction. Mr. A, who was the owner of the company A, who was the owner of the company B as well, Mr. A has controlled the transaction. Once after controlling the transaction, Mr. A has saved an interest of 100,000, saved an tax of 100,000 dirham. So this is a controlled transaction. In this controlled transaction, Mr. A has shifted the profit from the high tax jurisdiction to the low tax jurisdiction. This is the same thing, whatever we have discussed till now. Loan was 20%, 20 million, 20 million, 10%, 20 million, 5%. The differential was 100,000, 100,000 tax savings. So how it was 20 million, 10% less 5%, 19%, 9%. If you are multiplying it, the overall impact will be 100,000 dirham. So this is the control transaction. Ultimately, tax authorities are making loss, and Mr. A is making profit. Loss to the UK tax authorities, benefit to the UAE tax authority. The A is managing this transaction. So here's another example. Second example, in between the connected person. First transaction in between the related party. Second is in between the connected person. Now, assuming profit before interest and tax Assuming this is 100,000, in which was containing no salary, profit before, okay, I will say GP. GP is 100,000, salary is 50,000 to the CFO, remaining is 50,000. Assuming tax will be 9%, whatever the amount is coming. Now they are increasing the salary. Again, profit before tax is 100,000. If they are asking 80,000 are the CFO salaries, which is above the market price, just for the time being, I'm assuming it. This is not actual the case. So 30,000. 30,000 into 9%, they are paying lesser tax. How they are paying to the CFO above the market price. I'm just assuming this. So they are controlling. If you are paying higher salary above the market price, extraordinary salary, extraordinary benefit to the staff, just to avoid the tax authorities will intervene. So coming back to the definition, whatever we are discussing the very beginning, I said the transfer pricing is a price set in between the related parties and connected person. What is the reason? They can shift the profit and they can reduce their taxable profits. What is the introduction of transfer pricing? Now we understood the situation, and after understanding the situation, to control such situation, profit should be taxed in the respective jurisdiction. They said transfer pricing rules and regulations have been introduced. Transaction is not being influenced in between a relationship between the parties. It should be the fair market price. All related party transaction must comply with the transfer pricing rules and regulations. So now question arises, what are the transfer pricing rules and regulation, and how will you set the arm length price? Arm length price is meaning fair price. Whatever, if A, again, A is a company, A is selling to B, whatever the price A is charging to third party, principally A needs to charge the same price to B as well. So whatever the A is charging the same price to the B, this is the fair market price, this is the arm length price. So to control such transaction must not be influenced by the relationship between the parties, and all related party transaction must comply with the transfer pricing rules and regulation. Article 34 of the law says, while determining a taxable income, transaction and arrangements between related parties must meet the arm length standard. It has been very clearly written in the law. Transaction between the related party, transaction between the connected persons must be at the arm length principle. A transaction arrangement between a related party meet the arm length standard if this price is consistent. Arrangement are consistent in between the related parties and in between the related and third parties. For these purposes, different method has been given, and law says we need to follow the OECD rules and regulations regarding the OECD stand for Organization of Economic Cooperation and Development. We need to follow the OECD rules and regulation to set the market price, arm length price. There are different methods have been given in the OECD rules, OECD regulations, OECD, whatever the basically rule book has been issued by the OECD. So these different methods can be classified: traditional transaction method, which are the recommended methods. Then the transactional net margin method, which are the alternative method. So we will be discussing all these methods one by one in our coming webinar. But at the very high level, I'll say traditional methods are comparable uncontrolled price method, resale price method, and cost plus method. And transactional net margin methods are transactional net margin method, transactional profit methods are transactional net margin method, and transactional profit split method. As I mentioned, we'll be discussing all these methods in our coming webinars in detail. Alternative method. Law allows you that you can apply any other method as well. If any of these 5 methods is not suitable to you, then you can apply any other method. But the condition is it must provide the consistent result. It must provide the arm length principle. It must give us the price which is being charged in the market, fair market value. So which method is relevant for you, which method is not relevant for you, it all depends the nature of business in which you are in. Trading company, different method. Manufacturing company, different method. Manufacturing company having multiple processes, different method. The contractual term between the parties. If one party is buying 100 kg of goods and another party is buying 100,000 kg of goods, of course, price will be different. We need to consider this even as well. We need to consider the economic situation. We need to consider the characteristics of the transaction. We need to look into what are the assets are being employed, what are the functions that are being performed, what the risk is being taken between the parties. All these factors we need to consider while selecting the method to consider the transfer price. The most difficult part, I'll personally say the most difficult part in the corporate tax is how to do the benchmarking. Which method needs to be applied? How method needs to be applied? What factor needs to be considered? What should be the transfer price? What should be the premium? What should be the discount rate? What should be the contractual term characteristic? All these factors we need to consider while setting the price, fair market value price in between the related parties. And we need to be ultra careful while selecting the related method as well. If this arm's length principle is not being followed, as I mentioned, A party, company A, company B selling to company B, market price is 100, but A is selling at 50. If the transaction between the related parties is not on the arm's length, then the FTA will involve. Tax authorities will involve. Once these tax authorities will involve, what they will do? They will look into the transaction. Then they will identify what is the impact. Then they will suggest adjustment into the transaction. Profit will be adjusted accordingly. Impact will be adjusted accordingly into the transaction. At the end, they will calculate the profit, which will be as per the market value, and the businesses will be liable to pay the tax, or might be they will apply for refund. It depends upon the situation. But again, what I'm trying to say, if this price is not as per the market and the arm's length principle has not been followed, then tax authorities will involve. They will advise for the adjustment. This adjustment will be incorporated by the businesses. Taxable profit will be adjusted. At the end, tax will be applicable on the adjusted taxable profits. In the same way, if foreign competent authority, so this is a cross-border transaction. If this is a cross-border transaction, if the foreign competent authority is making any adjustment, this adjustment will be passed on to the local tax authorities, and this adjustment, local tax authority make a corresponding adjustment in the taxable income of the related person. This is a cross-border transaction. If you're selling cross-border from the UAE, people are selling any goods and services assuming to KSA. If KSA authority is making any transaction, any adjustment here in the taxable profit of the buyer or seller, whatever is, the competent authority of the respective jurisdiction will pass on to the FTA, and the FTA will make adjustment in the taxable income of the related taxable person. There is some documentation requirement as well for the transfer pricing. This documentation requirement is if the taxable part of the M&A group and the overall revenue is 3.1 billion or more, then documentation is compulsory, or the taxable person is local and tax revenue is 200 million or more during a tax period. 200 million or more during the tax period. Again, transfer pricing documentation is mandatory. So what is included in the transfer pricing documentation? Master file, local file, country by country reporting. In the master file, this is very high level information in the master file, like organization structure there, description of businesses, M&A intangibles, M&A intercompany financial transaction, financial and tax position, very high level. In the same, the local file, in the local file, businesses needs to document information about local entity, detail about the each category of control transaction, financial information, non-resident person, exempt person. All these information needs to be documented, and we'll discuss in upcoming webinars in detail. Local file, as I mentioned, they need to input the information in the local file as well. Country by country reporting is mandatory in the UAE. If your revenue is exceeding or equal to 3.1 billion dirham, then country by country reporting is compulsory. Transfer pricing rules and regulations, small business relief. We know this, if the taxable income of the business is up to 3 million, they may apply for small business relief, and this exemption is being granted. by the tax authority, then the businesses will not be liable to pay any tax up to the end of 31st December 2026. So transfer pricing rules and regulation, if the business is availing small business relief, then transfer pricing rules and regulations are not applicable on the small businesses. What is the way forward specifically for the transfer pricing? You need to identify the all related party transactions. You need to identify the transaction with the connected person. You need to apply the benchmarking study. This benchmarking study will be based upon the 5 methods. You can select any of them, or you can apply any other method which is giving arm length price. Then you need to adjust the transaction price. If you're not adjusting the transaction price, then at the end you will be required to adjust your profits, and you will be liable to pay tax on the adjusted profits. How can we help? As usual, impact assessment, implementation, advisory, and compliance services. Crest Cooper can help you. In the implementation section, transfer pricing, benchmarking is part of the implementation package. How to do the benchmarking? As usual, if you have any question, you can approach us. You can drop me an email at mahar@crestcooper.com, or you can give me a call. You can speak to a tax director, tax managers. We are always there to support you. We are always there to help you. We are always ready to listen, ready to understand, and ready to deliver. Any question, you can give us a call at 3391-488, or you can drop me an email at info@crestcooper.com. Thank you very much. This is over from my side. And if you have any question, you are most welcome. None of you has question today. Quite surprising. What is TP? TP stands for transfer pricing. Any other question? Will free zone entity will be considered a natural person? Though the definition of natural person is straightforward different. Natural person, sole establishment, civil company, or an individual who is acting as a freelancer will be considered natural person for corporate tax purposes. So we have already discussed in our previous webinars. So natural persons, as I mentioned, it can be civil company, it can be sole establishment, or it can be a freelancer who is working in its individual capacity. And any free zone company, if the free zone company is meeting all these conditions, free zone company can be a natural person. It cannot be as well, because the criteria is specifically there. If the companies are meeting the criteria, it will be considered a natural person. Okay, guys, thank you very much. Thank you and a lovely day. In case you have any question, you can drop me an email or you can give me a call as well. Thank you very much. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.